Hello, you wonderful, wonderful little boogers, you. Yes, that's right, Commissar Bro here today with week 2, or year 11, essentially, and projecting for year 12 of the business strategy game. That's right. Last episode was the first official week and us putting in our stuff. So basically, this video is going to be showing how we did. That's right. So, starting out, let's go take a look at the scoreboard. As you can see, DCB Shoes is in second place. A very strong, close second place, mind you. Competitive Footwear managed to beat us by about 5 points in the Best in Industry score, and 1 in the Investor Expectation score, and 3 points overall. So really, we're right on target. We're right behind Competitive Footwear. But, again, something that is important to note is we did totally build about, $70 million worth of stuff in the first turn. So that's really why we're so far behind. I mean, if you take away the fact that we built that, really we'd probably be in the lead. But no matter. Again, this is just the first turn. We've got plenty of opportunities to come back. So we've got a lot of reports we're going to be able to take a look at. We're going to go ahead and take a look at our earnings per share. We managed to achieve a $4.51 earning per share. That's right, not bad. Just a little bit behind C, with third place being Company E. That's right. If we look at our return on equity, once again, 25.9, real strong number. To give you an idea of what would be a really good number to get, about 30. If you can get a 30, you're doing absolutely wonderful. And earnings per share, if you can hit at about $7 per share, you're doing absolutely wonderful. And then if we're looking at stock prices, our stock is worth $77.34, whilst Company C is worth $91.45. So once again, C is pretty well in the lead, but not by much. Really, most of these numbers are really damn close, except for the stock price. But, I mean, that's only $14. Is it really that different? I don't think so. I think we're pretty close. So they definitely beat us in return on equity, stock price, and earnings per share. And again, a big part of that is because of the fact that we spent so much money right off the bat on industry. We're actually the only company that ended without any money. Basically, we had no money at all. We spent every last dime we could, which is going to benefit us, but in the following years. So let's go ahead and take a look at the credit rating, image, and CSRC. So right off the bat, once again, we can take a look at ourselves here. We've got a B+. Now, again, we took out a huge loan. This is to be expected. A B+ is still where we're still good. We're still good, and probably by next year, we'll be looking at an A-. We'll go over our forecasts very soon. Image rating, we're at an 83. That's right. We have the best image rating compared to the rest of our opponents by a long margin too. See, like as you can see between D and C, it's 10, and C is being a little bit more safe, I guess you could say, with like profits and total revenue. Hopefully for the second turn they keep things about the same so that they won't be expecting the major forecasts that I'm predicting essentially now, the major changes that are going to occur and the huge amount of money we're going to start drawing in. My overall plan is to kind of beat out C, but again, if it doesn't happen, it doesn't happen. So corporate social responsibility and citizenship, once again, we are spending a couple bucks on it ourselves, whereas a lot of people are not. Image rating points generated from CSRC, the high being 4, the average being 2, so on. So some people aren't doing that. We are. Right off the bat, I'll tell you right now, we are definitely doing that. I'm not sure how many points we're getting from it, but I guess it doesn't matter too much. Bonus point awards. How close were we in predicting our revenues? Well, we were off by about 8%, almost 9%, but in predicting our revenues. Our forecast for our earnings per share was also very off. It was 18% off. Look at G. G was right on target. And where were we with image rating? Now, image rating, we were much closer, but we were still 2% off. Ultimately, we got no award because the only person who actually got within 4 points and did everything right was company F. So they got 1 additional point for the Bullseye Award. That's good for them. The Leapfrog Award, beginning in year 12, 1 bonus point is added to the game-to-date overall score to the company whose current year overall score is most improved over the prior year. So this one doesn't apply yet, not till next year. And we're not too concerned about it because ultimately our points are so high, and if we maintain our high points, we won't even need to worry about the Leapfrog Award. Overview, plant capacity. So taking a look here, we can pretty much see right here, and these are the 2 most important pieces, really, of all the information you can see on this screen. And that is what the total supply is, basically how much factory capacity everyone has, and how much potential demand there is. As you can see, there is 10 million more supply of shoes than is currently being demanded. But in the next turn, we're going to see the market grow. We're going to see it grow pretty damn big. Now, if you look up here, it gives us better forecasts of what our experts essentially are predicting is going to happen. Ultimately, it's in our benefit to not increase our capacity anymore. We're at the point right now where we can maintain a pretty large share of the market selling our shoes, outpacing production of everybody else. Really, we're outpacing everybody. Company E here actually sold off 2,000 capacity, and Company A sold 200. Again, I don't think selling off any capacity is a good idea, so I didn't. But if we look here, Company D, that would be us, we produced 2,000 in the last turn, as you guys already know, giving us a total of 8,000 total production, a 2,000 lead over pretty much everyone else. I don't think anybody else actually built anything. Yeah, new construction initiated in year 11. Nobody built anything. So, let's go take a look at the financial summary. Here we go. We can see a bit more data, like how much money we ended up with. As you can see, nothing. We literally ended on nothing. But the amount of money that we made, or we predicted and forecasted, ultimately, I was right on. I was dead on, basically. I only overdrafted by about $400,000. Considering we're toying with $400 million. I mean, that's within a 1% margin. That's less than 1% of a margin, so 0.1%. I'll take that. Like, truly, I will. Because that means that my overall forecasts, although optimistic, ended where I wanted them to end. The way I see it is the forecast should be optimistic. You should try to basically perform as best as you can and display those figures to a degree. Because then, when you hit the marker, you're still going to be within the general area of where you expect it to be. Which is, again, I'm very happy with where we ended up. Now, if we take a look, comparing ourselves to the other guys, it says current assets at 91,000. We have lower assets than our competitors. Most of our, honestly, we have lower than E or C. And A is right on our tail. But if we look at total assets, we're far and beyond in the lead in terms of total assets. But we do have high liabilities and we have high long-term debt, thus effectively causing us to kind of fall back a little bit. We're spending more money right now to pay off our interest in our debt. So basically, when comparing it to our competitors, we're kind of behind. But this is something we can fix, and I'm not overly concerned about. $100 million is something we pretty much make in a year, so I'm not too concerned about it. And the rest of this data I'm not too concerned with at the moment. Ultimately, though, C did win out with a higher ending equity than everyone else and more earnings retained than everybody else, but not much further than us, really, not much at all. Roughly $1.65 million is how much they retained over us. So basically, that's how much they made in profit. Which, considering what we're doing and all the major construction we've performed and whatnot, I'm cool with that. Whatever, that's fine. So let's take a look real quick at selected financial and operating statistics. Looking at us, 51% of the cost of pairs sold, so on. Wholesale expense, 6.2. We can see that C kind of beat us with marketing expenses. They tried to take a dominant share of the market, but so did E. I guess what's weird about E trying to take using so much marketing to take such a large share of the market they don't have the production to keep up with it. So I don't really understand what strategy he's going for there, but it'll be interesting to see what he ends up with. Again, we can see our debt to assets ratio is higher than everybody else. Our interest coverage ratio is less than C. But the default risk of C is the lowest, which is good for them. That means that they are not taking too many risks with loans, but ultimately I feel like our risks will pay off in the end. There's performance benchmarks, which basically tells you, how your plants did, what they produced, total compensation, so on and so forth. But we're not really going to go through this. But another important thing to mention is indeed that we did manage to sign both of the celebrity contracts we went for, which is Oprah, Beyonce, and Cristiano Romano. And I was right that nobody was going to go for Cristiano Romano, but I did suspect that someone was going to go for Oprah, Beyonce, and no one did. What I should have done is I should have just bid $1 million and put my spending limit upwards of $4 or $5 million, and we would have been good to go. But whatever, it happens. So let's take a look real quick at basically our forecast for next year of all the changes I've made thus far. I'm not going to show every single change, but I'm going to try to show the majority of them. Starting off, if we're looking at earnings per share, we're projected for $6.48 a share, which is pretty damn good. It's not as good as my week 2 practice, but then again, I didn't have as strong of a competitor in the week 1 and 2 practices with Company C. Company C, right out the gate, scares me because they're making money and they're doing things the right way as far as I can tell. So they're definitely going to make this far more of a challenge than I was expecting. So, but that's neither here nor there. Essentially, what we're projecting for next year, for year 12, is going to be 6.48 share, earnings per share, a return on equity of 28.3%, which is still really strong, a credit rating of A-, and an image rating of 90-7, son. Basically, the image rating of our shoes and our company is absolutely wonderful. People look at our company like we are a godsend, and that's absolutely wonderful. Truly, I'm perfectly fine with that. The only corporate social responsibility and citizenship things I'm still going to stick with is workforce diversity and ethics training. I'm not too concerned about green footwear materials or any of the other stuff. Really, I'm not. I'm far more concerned with this, and that gives us just enough of an image boost, as you saw, to boost us way up past our opponents who did not do this at all. So I'm happy with that. If we look at net revenues, we're looking at almost a 50% increase to revenues at $454 million and a net profit of around $64 million, basically on the variables I've done so far. And we're looking at an ending cash of upwards of almost $23 million. So we're going to have $23 million roughly in the bank. At least that's what it's projecting. That's not necessarily what will happen. That's just what the game, if everything stays roughly the same, or if we put up good predictions, that's basically what's going to happen. So essentially, I've done a bunch of number changes here, and as you can see, I'm trying desperately to gain a dominant share of the wholesale market. I want the wholesale market. Again, just to give you an idea what wholesale is branded. We're trying to get control of the branded market. An example of a strong branded, like a wholesaler, or in this case, a branded shoe would be Nike or Adidas or New Balance, a big shoe company like that. And that's the market we're trying to get a dominant share on right now. Last week, I was going to look more at the private label and more at the internet segments, but looking at the sales volume, it seems very clear we need to take the control of the wholesale market. Right now, we have the best quality shoes of all of our competitors, hands down. Looking at these numbers, you can pretty much tell that our competitors didn't really care about the SQ rating of their shoe. Whereas I did. I care about the quality of my shoe. I want to provide the best bang for my customer's buck. So with that in mind, selling good damn quality shoes for exorbitantly mid-range to low prices seems like a pretty strong strategy out the gate. Once we get more dominant shares of the market, then we can start experimenting with changing prices if rising them as needed. But I'm looking more right now at kind of taking control, especially because we have a strong market competitor in Company C. So, with that in mind, increasing our advertising budget is a big thing right off the bat. Right down the line, I'm increasing it, and especially in Europe and Africa. If we look, this is reflected in the forecast for a regional market share. As you can see here, we're shooting for a year 12 forecast of 30.5% in the internet segment, 16.9% in the wholesale segment, and that's in North America. In Europe, Africa, we're looking at 31.9% in internet and 23.3% in wholesale, which is literally doubling our share of the market there. And if we're looking at Asia Pacific, 27.9% on the internet, 15.2% in the wholesale, again, almost doubling the number, 29.1% in the internet segment, and 17.8% in the wholesale. So I want to take control of the Europe-Africa market, first off, because no one has factories there. Nobody. So with that in mind, we are automatically going to be able to produce shoes cheaper than everyone else. And there's really no debating that. There's no arguing it. We will produce shoes faster because we're the only ones who have the production there. And we can produce it faster and cheaper than they can because they have to import it from somewhere else. So basically, if they make their shoes in North America and they try to ship it over to Africa, it's going to cost them money, which it's not going to cost us any import tax at all. However, that's all based on how you do your distribution, which we'll go over in a little bit. Anyway, this is my focus right now, and I'm probably going to increase some numbers here or there, like retailer support, making sure that my retailers are indeed supported and that they want to stick with me. They like what I'm tossing out there. And if we look at that, increasing retailer support actually brought up our total revenue. It kind of put a small dent in the net profits, but honestly, it's hundreds of thousands of dollars. I don't care. Like, as long as I'm seeing my millions stay there, we're good. We are perfectly fine. And increasing these numbers is going to be incredibly beneficial in securing us a larger share of the market. But we want to be careful not to take too much of the market, because if you look here, with total branded production needed, basically we're saying about 7,000 pairs of shoes. With my current forecast, with my current production, my current models offered, so on, that's how many shoes we're predicting we're going to need to make. Now, production capacity available for private label, with overtime and whatnot, is actually looking more at 2,500 roughly. So if we go and we take a look at the distribution, we can see right off the bat exactly where our negatives are going to be. And we're going to have a negative 10 inventory surplus in the North American warehouse. So what I'm going to do is I'm going to change this number to 431. And I'm going to increase this to 1311. So that means that our inventory shortfall is now at 0. As you can see, I'm cutting it really close here. Like, considering we're producing millions of shoes, I'm cutting these numbers down to tens of thousands, which is kind of scary. And you got to be really careful about that, because if you don't meet your demand, you're going to lose money. Like, if you're not meeting demand in that certain warehouse, you're losing money. And it's not good for you. You want to try to maximize as much profit as humanly possible. But I feel like these tiny little min-maxing where I'm doing it is really going to assist us in boosting up our revenues, which is ultimately what I'm very concerned about. Now, you should be focusing on profits, absolutely. But again, this is still early on, and I want control of that market. If I can get control of that market for even a turn, then the increase we're going to see on the turn after, when we raise prices just a little bit, is going to be huge. We're going to have a much larger impact, and that's kind of what I'm shooting for. So I'm doing a lot of experimentation here, which it might not turn out how we want it to, but I'm feeling pretty optimistic. I really am. And I mean, these operating profit margins are wonderful. Truly they are. I mean, 30%, 40% roughly, and an overall net profit of 43.1% is exactly what I want. Even then, talking about how my year 12 ended up being, this is pretty damn close. This is pretty close indeed, except our image rating is much higher this time around. But ultimately, our net profit and our revenues are looking just about the same. I'm sure if I actually pulled it up, I could see it for sure. So looking at wholesale marketing, yep, everything's pretty good here. This is a little bit more in-depth look if we wanted to go into it and figure out what we wanted to do. I'm pretty much happy with all these numbers, I think. I could increase this to 0.5. Yeah, see, we would sell less shoes, and I would actually lose less revenues. I'm not really a big fan. So let's say 44.5. And boom, see, that bumps us up a good deal. I could actually bring this price down a bit more. No, I can't. It's already at -7. So we don't want to finagle with the numbers too much. Again, I could still make a good amount of money. And I don't know. I'm cool with this. I'm really cool with taking that much of the market. That ultimately makes me happy. That should be really good. And again, we want less shortfalls than we had the year prior, which was, as you can see, we ended with 128 pairs of shoes in North America in the warehouse, 223 pairs of shoes in the Europe, Africa market, and 179 pairs of shoes in the Asia Pacific market. So with these numbers being much lower, much closer, I feel much better about it overall. I feel like we'll sell these and we should be good. Let me see if I can increase that number a bit more. Not really. Yeah, not really. We're only going to sell a couple more shoes. It does give us the better retailer support, but it's not worth the couple extra bucks we're going to get. Does it? Yeah, and it only gives us 0.1% more of the market. So I'd prefer to just leave that where it is. But anyway, this seems pretty good. This seems pretty good. The one last thing I'll basically talk about, because everything else is pretty much set in stone at this time. Here you can see the private label stuff. So if you were curious about what's getting shipped where, here's your screen for it. Really, I need to finagle some of the numbers a bit more, because there's no reason for me to send anything to a market if I can already send it there. So, for example, nothing's coming to the Asian Pacific warehouse, but is there some changes I can make somewhere along the way? Maybe. I'd have to look at it. I'd really have to sit here and kind of mess around with it. I think I already kind of did, to try to maximize the highest potential I could get from my money. And whatnot. But again, if my bids are accepted, look, those are the shares I'm gaining from the market, assuming my bids are accepted, which I don't see why they wouldn't be. Truly, I'm gonna make my money. I'm gonna make it. But anyway, this has been Commissar Bro, and thanks for watching, guys. I hope you've enjoyed this little video. I hope you're enjoying me talking about this game, because I'm pretty excited about it. I really enjoy this game and the friendly competition between me and my classmates. It's really cool to kind of see all this stuff play out and to see what happens. So yeah, again, like I said, I hope you're enjoying this, and I hope you're interested in this type thing. We have, after this week ends, we'll have an additional 8 weeks to go of the game. So it's going to be a hell of a struggle to stay on top for that whole time. And let's be real, I'm probably not going to be able to do that. But I hope so. I really do hope so, because I could see our business doing very well in the long run. And we might actually pay back one of these loans. Not that one, that's for sure. Maybe this guy. Yeah, we could probably pay this guy back, and that would bring our default risk lower. And I think that would make some people happy with our money situation. But who knows? Plus, look how much money we're actually paying back. If you look right here, the principal repayment, that's expenses every year that's going into paying loans off, which is a shit ton of money. So yeah, that's a pretty good amount cutting into profit. Like, if we took all that and we paid all our loans back, and we put it into straight pure profit, we would be making over $100 million a year right now. So yeah, we're going to pay that stuff back. But anyway, this has been Commissar Bro. Thanks so much for watching, and I will see you wonderful people next time.